Hi, my name is Jose Hernandez, and I'm an Associate Director of Loans here at the University of Southern California, and I'd like to welcome you to our Student Loan Exit Counseling session. For the next 45 minutes to an hour, we'll go over what to keep in mind as you manage this investment you've made in your higher education. Some housekeeping items before we begin. If you've logged into the webinar, that will serve as our record of your attendance. Please note that we will keep count of your time in the session, so your attendance will be logged. I'm joined by my colleague, Luana Calvin, who will be able to answer questions during the presentation. Please note that there is only one of her and about over 200 of you, so please be patient with your questions. Oftentimes, the questions that students have are questions that will be covered in the seminar. For those in attendance, we will provide you with a copy of the presentation along with a survey for you to complete at a later time. This will be before the winter break actually commences. Our audience consists of both undergraduate and graduate students, so we will be discussing some items that may be geared to one specific population. Those items are few, with the majority of the topics discussed being applicable to everyone. So let's begin. In this presentation, we'll go over the various loan programs students at USC may have participated in to help finance their higher education. We'll discuss what your rights and responsibilities as a participant in these programs are. We'll go over the repayment plans that many of our students have taken advantage of, including income-based repayment plans and public service loan forgiveness. We'll discuss the options available if you are unable to make repayments on your student loans in the immediate future, some tax benefits available as a result of making payments towards your student loans, as well as the consequences of going into default, meaning not making payments without having coordinated something with your servicer. Finally, we'll briefly go over some means of managing your current finances to help facilitate a healthy start in managing your student loan repayments. All of the loan programs offered through the university fall under two major categories: subsidized and unsubsidized. Subsidized loans are loans that the government pays the interest on while you're in school and during approved deferment periods. They will also pay the interest during your grace period, except in some cases for the Stafford loan, which we'll go over in a bit later. Unsubsidized loans are loans wherein you're responsible for paying all of the interest that accrues, including interest that accrues while you're in school and during your grace period and deferment periods. The subsidized loans at USC include the institutional loans, Perkins loans, and federal direct subsidized Stafford loans. One note regarding the subsidy for Stafford loans: the provisions of the Consolidated Appropriations Act of 2012 eliminated the grace period subsidy for direct subsidized loans first disbursed on or after July 1, 2012, but before July 1, 2014. This means interest began to accrue on these loans as soon as the student ceased to be enrolled at least half-time. So though typically the interest of subsidized loans are taken care of during periods of grace and deferment, that is not the case for loans originated during this period. Unsubsidized loans at USC include the unsubsidized Stafford loan, all PLUS loans, whether grad or parent plus, and finally, private student loans through an outside financial institution. In utilizing these resources to finance education, you have certain rights and responsibilities to be aware of and adhere to. Many of these things were first disclosed in the promissory note for your federal loans or disclosure statement if you've borrowed through an outside financial institution. These rights include: you have a right to know how much you borrowed, to whom you must make those payments to, complete transparency towards who to contact if you have any questions or concerns, and you have a right to prepay any amount of your loan at any time without penalty. Consequently, you also have responsibilities as well, including the obvious: pay back the loan. To assist in the repayment, you have the responsibility of letting your servicer know of any changes to any personally identifiable information, including email, name, address, your student enrollment status. For example, if you enroll in another program of study. Also, and I'll touch about the importance of this later, if for any reason you are having trouble making a payment, it is your responsibility to let your servicer know that you cannot make the payment so that they can assist you with selecting either a lower repayment plan or placing you in an approved deferment status. The first step in understanding how to manage your student loans is by knowing what and how much you have to manage. Borrowers can log into studentaid.ed.gov to view their federal student loan information, including loan balances, interest rates, and loan servicer contact information. A loan servicer is a company that handles the billing and other services of your federal student loan. Your loan is assigned to a loan servicer by the U.S. Department of Education, or ED, after your loan amount is first disbursed or paid out. The loan servicer will work with you on repayment plans and loan consolidation and will assist you with other tasks related to your federal student loans. It is important to maintain contact with your loan servicer. If your circumstances change at any time during your repayment period, your loan servicer will be able to help. After you have identified your federal student loans and who your servicers are, you may decide that making multiple payments on student loans, you want to consolidate these into a federal direct consolidation loan. A direct consolidation loan allows you to consolidate or combine multiple federal education loans into one loan. The result is a single monthly payment instead of multiple payments. Note that you have to apply for a federal direct consolidation loan and, like your other loans, sign a master promissory note in order to begin the process. You can do so on studentloans.gov, on the same site where you will complete online exit loan counseling. Once you've submitted an application on studentloans.gov, they will link up with the National Student Loan Data System, or NSLDS, to pull all of your student loans automatically into your consolidation loan. To keep a loan out of your consolidation loan, for example, a Perkins loan, you will have the option to remove it during this application process. During this process, you are also able to choose your servicer from a list of current direct loan servicers. So if you have a servicer that you're already happy with, you may stay with that servicer as part of your consolidation. After the loans and servicer are selected, a notification of the amount that will be paid out to your servicers is sent out to you as an FYI, but also for your second review to make sure everything is correct. Your selected servicer then pays off the old loans and sets up your new account or updates your existing account if you did not change servicers. Note that this process can take up to 60 to 90 days, which means you may be required to make a payment of your student loan or apply for deferment until the process is completed. In my experience, though, this process has sped up significantly in recent years, and in some cases, consolidation has taken as little as 30 days and sometimes even sooner than that. So to recap, for federal loan consolidation, review your loan history on studentaid.ed.gov. Then, if you're in a grace period, you want to make sure you complete and submit the direct consolidation loan application beforehand, either through a link from studentaid.ed.gov or directly on studentloans.gov. While you're in the process of consolidating, speak with your selected servicer regarding upcoming payments or deferments while the application is being processed. Now, what are some pros and cons of consolidation? Some pros. You may gain access to other perks through consolidation. For instance, you have to consolidate your federal direct student loans into a consolidation loan, especially if you have any of those previous FFEL loans, in order to apply for public service loan forgiveness and for some income-based repayment plans, such as pay-as-you-earn or the revised pay-as-you-earn. Also, for graduate students, if you've obtained a Grad Plus loan through an endorser, consolidating your Grad Plus loans into a federal direct consolidation loan would relieve the endorser of their obligation to pay back that loan. Some cons include consolidation does make your repayment term a little longer. This is because when you consolidate, you essentially are taking out a new loan that pays off all of your other loans. The length will depend on how much you consolidate, but as an example, the repayment period for an amount that is under $10,000 is up to 12 years, which is longer than the default 10-year standard repayment plan, which we'll get into more detail later. So though consolidation may decrease your monthly payments, it may likely increase how much you pay overall, as you pay significantly more in interest over the lifetime of the loan. If you are going to consolidate, you should consider doing it during the first year or second year of repayment. Some benefits for certain loan programs outweigh the cost of consolidation, and students often opt to exclude certain loans from their federal direct consolidation loan. So though you can consolidate a Perkins loan into a federal direct consolidation loan, some students see the benefits and the grace period and the interest rate of a Perkins loan as more beneficial, and so choose not to include that one as part of their federal direct consolidation loan. Some items are not necessarily a pro or con, but depending on what your financial goals are. Interest rate, for instance, is one of those items. Interest rates won't change after consolidation, meaning that once you've consolidated your federal direct student loans, the interest rate will remain locked. If your loans have variable interest rates, consolidation will lock your loan into a single rate for the rest of your repayment term. That is great if the rates go up. Unfortunately, if the rates go down, your loan will be more expensive than it would have been otherwise. If your interest rates are already fixed, you won't get a lower rate by consolidating, even if it appears that way. Consolidation interest rates take the weighted average of the rates of your underlying loans, then round that number up to the nearest 0.125%. Many borrowers confuse consolidating with refinancing loans at a lower interest rate. However, you cannot refinance federal student loans at a new interest rate and keep them in the federal student loan program. In other words, if you were to refinance them, they wouldn't be considered federal student loans and thus wouldn't be eligible for some of the repayment options and forgiveness programs that are offered. Also, as a reminder, once you've begun submitting your application for loan consolidation, your grace period will end regardless of how much time you have remaining. It's important to be in contact with your servicer during this time to ensure that you will not be penalized. Servicers can assist you either in placing you in a state of deferment where no payment is required, or alternatively, you may be making payments under the standard repayment plan until your consolidation is complete. Let's talk about interest rates. Interest is the fee a lender charges you for borrowing money. It's a percentage of the amount you owe that accrues and gets added to your principal balance on a regular basis, usually either daily or monthly. Student loans can come with either a fixed or variable interest rates. A fixed rate remains the same over the lifetime of your loan. Variable rates shift typically annually based on market factors. Variable student loans typically change rates every July 1st, which means that, surprise, your payments may go up or down around that time. Stafford loans and PLUS loans have fixed interest rates set every July 1st. This means that your Stafford or PLUS loans will likely have different rates every year you borrow, but each loan's individual rate will not change over its life. Think of this as a variable fixed rate, if that makes sense. When student loans are in repayment, interest accrues on them every day, and, depending on the loan type, interest may accrue while you're in deferment and/or while you're in school. If you don't pay the interest accruing on your loans, it may be added or capitalized into your principal balance. If that happens, you'll begin being charged interest on your unpaid interest. For our unsubsidized loans, interest has been accruing while we were in school. We haven't had to make any payments due to our school deferment status, but once we've entered into our grace period or entered into repayment, that interest is added on top of the principal balance. This is what is known as capitalization. Interest on loans is capitalized each time we enter into a status of deferment or repayment. Private loans have their own schedule based on their disclosure statements. So it behooves you to look at your disclosure statements to find out how often interest is capitalized on private student loans. Note that though you may not refinance a student loan to obtain a lower interest rate per se, there are opportunities your servicer may provide to lower that interest rate a bit. Your lender may provide a partial point off your interest rate, typically 0.25% or 0.5%, for signing up for automatic payments or for making a bunch of payments on time, 2 years for example. Additionally, making interest-only payments on your student loans during your period in school or during grace or deferment will reduce the overall interest later capitalized when you enter repayment. Now, granted, this is an exit loan counseling, so oftentimes this is the case where you're not necessarily going to go back to school, but for undergraduates thinking of going into graduate school or a professional program, it would be something to think about when knowing that the amount of loans that you are likely to take in those programs is likely to be higher. So in order to lower the amount of interest that's capitalized on those student loans, interest-only payments while in school might be an option for you. There are a couple of statuses that you can find yourself in when managing your student loans. The most common for first-time undergraduates and for some graduates who have borrowed and have maintained at least half-time enrollment throughout matriculation is known as grace period. This period is automatically granted to students and no application is required. The status is outlined to the student within the master promissory note. A grace period is the time before your first loan payment is due once you stop attending school at least half time. Different types of loans have different grace periods, so check with your loan servicer to make sure you know your first payment's due date. Federal direct student loans typically have a 6-month grace period, except, however, subsidized Stafford loans dispersed between July 1st, 2012 and July 1st, 2014, who don't get that subsidy, as I mentioned earlier. Perkins loans receive 9 months of a grace. They also get a 6-month quote-unquote grace after periods of deferment. But for more information for that, you should contact your servicer for your Perkins loan. Grad Plus loans dispersed as of July 1st, 2008 have a 6-month grace period. However, if you borrowed these loans before that date, you would have had to request that 6-month period. For undergraduates of parents who've taken out Parent Plus loans go into repayment 60 days after they are fully disbursed. However, parents can request a 6-month grace period to defer repayment until after their son or daughter graduates, withdraws, or drops below half-time. Health profession loans, including health profession student loans, HPSL, loans for disadvantaged students, LDS, nursing student loans, NSL, and primary care loans, PCL, all have 12-month grace periods. Federal consolidation loans do not have a grace period based on the nature of the loan because you're consolidating in order to begin repayment, so there is no grace period for federal consolidation loans. Private loans may or may not receive a grace period. Borrowers should review documentation surrounding their private loans for more information regarding grace periods for private student loans. After your grace period is over, you will enter into repayment status. There are a number of repayment plans available to meet each student's financial circumstances. The most common is standard repayment. This is the federal student loan repayment plan that you'll be automatically enrolled in if you don't choose a different one. It allows you to pay the same amount every month for a period of 120 months. If you stick to the schedule, you repay your loans in 10 years. Graduated repayment plan is still within 10 years. Your monthly payment will be lowered during the first couple of years of repayment, but after it'll go up significantly. Ultimately, though, you are insured to complete your repayment within 10 years. Essentially, you start off with lower payments in the beginning that slowly increase every 2 years. That's the difference between graduated and standard. Some students may opt to extend the repayment beyond those 10 years. If you have a lot of federal student loan debt, but you don't qualify for low payments under an income-driven repayment plan, extended repayment may be your only option. Your monthly payment will be reduced, so you pay one low amount for a longer period of time. You can have up to 25 years to pay back your loan, 300 payments, or 30 years and 360 payments for consolidation loans over $60,000. Finally, those plans that are tied to your income are called income-driven repayment plans, or IDR payments. IDR payment lengths vary depending on the repayment plan, and if in conjunction with a loan forgiveness program, can be significantly less. Choosing a repayment plan can seem daunting, but there are a number of tools that borrowers can use to help facilitate choosing the best repayment plan, given their personal lifestyle and finances. This slide illustrates some of the sites students in the past have used to use the repayment estimator tools. StudentAid.gov is a great start for estimating your monthly payment, as it will be the first site you go to when determining how much federal student loans you have out there. In an effort to drive the importance of choosing the right repayment plan and make your financial goal of paying down your student debt more successful, StudentLoans.gov also provides a repayment estimator as a convenience, which will assist you in making decisions, especially when considering consolidation. And finally, saltmoney.org is a literary tool USC has partnered with to provide on-demand assistance for any questions you might have regarding meeting your financial goals, whether it's paying down your student loans, finding a job, or making a big-ticket purchase such as a car or home. As part of their toolkit for managing student loans, they also have a repayment navigator that will help in comparing which repayment plan is right for you. The added benefit of SALT is you may speak to a live person via phone or chat to help in deciding which options may be right for you given your current circumstances. In the following slides, we'll focus on the repayment estimator tool for studentloans.gov. Though which estimator tool you decide to use is up to you, I'll walk you through how this tool can assist you in choosing the best repayment plan for you. You'll also find that there are a number of common items each estimator tool requires to give you a better picture of what your monthly payments may look like. These items are your loan balance or estimated loan balance, adjusted gross income, even if that means that it's zero, family size, and in some instances, a state of residence may actually have an impact as to what type of repayment or monthly payments you'll have. I'll use the estimator on studentloans.gov to demonstrate. So once on studentloans.gov, they have it a little bit hidden, but it's at the very bottom where it says repay your loan, estimate your payments. That'll take you to a very friendly, user-friendly site, which will ask you to log in. The good thing about logging is it'll automatically give you the option to be able to pull down all of your loans from the National Student Loan Database System. Studentloans.gov provides an excellent tool for students to access all of their federal student loans in one place and estimate that their monthly payments will look like under a given plan. Here you'll indicate which is your AGI, what your loan balance is. You can even add the loans, or they just use the loans from NSLDS. Like I mentioned, you'd have to enter an adjusted gross income. You can use this also as a kind of a comparison to see what you anticipate your salary might be and incorporate that for future planning. The comparison chart there will show you how much. As mentioned, you can adjust the estimator tool to account for any possible changes of your income, whether it's a change of employment or even a promotion. This tool will help you consider what impact, if any, your new salary will have on your spending plan. The comparison tool is not only good for seeing what range your monthly payments will be, but also give you a good idea of how much you will be paying overall the life of that loan. It will even adjust the time frame accounting for enrollment in public service loan forgiveness, which we'll discuss in a bit. If you have federal student loans, you'll automatically be enrolled in standard repayment after your grace period ends. This means you'll be required to pay the same amount every month for 10 years, 120 payments. If you make all 120 payments on time, your loans will be completely repaid at the end of that period. Remember when we were talking about accrued interest on your student loans? Well, every time you make a payment, a portion of that money goes toward the interest that is accruing on your loan and any fees that you may have been charged, and the rest is used to pay down your principal balance. Through standard repayment, the amount initially paid goes almost all to interest and some to principal, but with time, your interest lowers as you're paying down the principal. Your monthly payment amount may be higher under standard repayment than with another repayment option, but this plan generally costs you less in interest in the long run. If you can't afford the monthly payments, you may be able to choose from a number of other options to make them more manageable. Just note, you may change your repayment plan once a year. But between that period of change, you will have to go into 1 month of standard repayment while that change is occurring. You can also make payments before they are due or pay more than the amount due each month. Paying a little extra each month can reduce the interest you pay and reduce your total cost of your loan over time. If you want to ensure that your loan is paid off faster, tell your loan servicer that the extra you pay is not intended to be put towards future payments. Why does it not all go towards the principal when you make an extra payment? When you make a large payment, lenders are required to first put your payment towards any outstanding fees, then interest, and then your principal. Talk to your lender before you make a large payment so that you can be sure you know where that money is going. Graduated repayment let federal student loan borrowers lower their monthly payments without extending their repayment period. It's still 10 years. That can mean small bills now, but big ones later. You pay just the interest on your loan for the first 4 years. Some servicers will increase your payments every 2 years instead. Payments then increase, sometimes dramatically, but can't be more than 3 times your previous payment. You finish making your payments in 10 years, similar to the standard repayment plan. Graduated repayment still increases the total amount of interest you pay. So notice, though you do start at the very beginning of the first 4 years at lower payments, slowly going up, those first 4 years, those funds are going directly towards interest. So you are paying overall more interest in the long run. Not every federal student loan borrower is eligible to use extended repayment. To qualify, you must have borrowed at least $30,000 in loans through either the Federal Family Educational Loan Program, or FELP, or Direct Loan Program. In addition, if you took out your oldest loan before October 7, 1998, you cannot use extended repayment. Extended repayment, your monthly payments are lowered, but you'll make them for longer. Essentially, they extend it over to 25 years to repay your student loans, or 300 payments. If you don't qualify for income-based repayment or income contingent repayment, extended repayment is a good alternative. The only drawback, of course, is that having extended your payment period, you're paying a lot more in interest. This chart slowly compares the main standard repayment plans, standard 10-year repayment plan, graduated repayment plan, extended fixed, and extended graduated. Note, though the standard repayment plan has the higher beginning monthly payment, overall, the total amount of the loan paid is lower than the other programs. Something to consider when deciding which repayment plan is right for you is understanding what your earning power will be once you enter the workforce, whether that's immediately after college or your program of study or after your graduate or professional school if you're seeking to do that. Salary.com and the U.S. Bureau of Labor Statistics provide good information that will assist with understanding a realistic salary. When it comes to your post-college salary, expect an amount in line with your education and your experience. You may earn more, but you won't get there without starting with a realistic number. So do your research. Start by seeing what the average salary for recent grads and entry-level positions are in your field. But remember that a lot of factors, including where you live, go into whether you'll be above or below that average. Knowing what your starting salary could be will assist you in determining a base AGI to use for the repayment estimator tools previously mentioned. If you have large loan balances and loan incomes, federal student loan borrowers may qualify for few options that make their payments more affordable. These plans, income-based repayment, IBR, and pay-as-you-earn, PAYE, and the revised pay-as-you-earn, REPAY, even forgive borrowers' remaining balance after 20 to 25 years. 10 if they're working in conjunction with a nonprofit or public service employer and enrolled in the Public Service Loan Forgiveness Program, which we'll talk about later. There are two versions of IBR, or income-based repayment, old IBR and new IBR. Which one you qualify for will depend on when you first received your loans. New IBR is for new borrowers who did not have a direct loan or FFELP loan balance when they received their first direct loan disbursement on or after July 1st, 2014. Old IBR is for everyone else. Also, for purposes of what the percentage of discretionary income used, old IBR uses no more than 15%, while new IBR uses no more than 10%. All married borrowers, including those who file separate federal income tax returns, must provide documentation of their spouse's income. Certain exceptions do apply for applying for an income-driven repayment. For IBR and pay-as-you-earn, if you file your taxes jointly, your spouse's income and federal student loans will be included in calculating your payment. If you file separately, they won't. In either case, you can include your spouse in your family size. It's true for old and new IBR as well. Repay, or the revised pay-as-you-earn, borrowers must provide their spouse's income when applying whether the couple files for federal tax returns jointly or separately. The only exception to this is when a couple is legally separated or the borrower cannot reasonably access the spouse's income information. Spouses cannot be included in the family size if the spouse's income is not provided. Sounds pretty good, right? It's because it is, but like many good things, there's a catch. You have to qualify for these options each year, and lots of borrowers forget to reapply. Also, one thing that should be noted is that in those moments when income-based repayment or the pay-as-you-earn or revised pay-as-you-earn forgives a certain portion of the loans, be aware that the amount that is forgiven is considered a taxable event. So you want to take that into consideration that year that you are qualifying for that loan forgiveness. Just so you know, if you had any balance on a FFEL or direct loan before October 1st, 2017, you more likely will be leaning towards income-based repayment. Pay-as-you-earn or repay are for direct loan borrowers only, and FFEL borrowers may qualify for pay-as-you-earn or the revised pay-as-you-earn only under a direct loan, federal direct consolidation loan. Discretionary income is the amount of money that you have left over after paying for your basic expenses. You may need to provide this information when applying for certain student loan repayment plans that determine your monthly payment amounts based on how much you earn. We'll provide some examples in the upcoming slides. For the first 36 consecutive months, excluding any period when you have an economic hardship deferment, if your monthly payments don't cover the monthly interest accrued, you do not need to pay the amount accrued that you did not cover on subsidized loans or subsidized portion of consolidation loans. Here's an example. An annual income of $40,000, a monthly income of $3,333, total educational indebtedness of $35,000. Under standard repayment, that $35,000 at 6.8% would be $403. Under the old IBR program, the student's annual income is taken into account, removing 150% of a poverty level for the marital status of the individual. That leaves a discretionary income of $22,345. They'll use 15% of that, $3,351, and then divide that by the year so that your monthly payment under old IBR would be $279. Similar, pay as you earn, revised pay as you earn, and new IBR use the same logic and formula, except they use 10% of your discretionary income. Similar to loan consolidation, you would go to studentloans.gov to apply for income-driven repayment plans. One of the items that you must do when applying for income-driven repayment plan is verifying your income to ensure that you qualify for these programs. You will be given the option to document your income electronically using a data retrieval tool, the IRS data retrieval tool, that we have established with the Internal Revenue Service. If you do not want to use your adjusted gross income to have your payment calculated because your income has gone down since you filed your last tax return, you will be able to provide documentation of your current income to your loan servicer. If you do not currently have any income, you will be allowed to self-certify that you do not have any income on the application. Note that you must certify your income and family size each year to qualify for the income-driven repayment plans. A simple formula to find out whether you need to supply supporting documentation: if you filed federal tax returns for the last 2 years, if your current income is not different from that reported on your tax returns, then you can use the IRS tax return data retrieval system or tool. Otherwise, you would have to supply alternative documentation of income. Same if you haven't filed any taxes for the last 2 years. Now let's talk about public service loan forgiveness. Public service loan forgiveness, or PSLF, encourages borrowers to go into public service or the nonprofit sector by forgiving their federal student loan balance after 120 eligible payments made while working full-time with an eligible employer. The loans have to be direct loans, so if you have other federal loans, you'll need to consolidate into the direct loan program to potentially qualify. Payments made to your loans before you consolidate into the federal direct loan program don't count toward your eligible payments for PSLF. So if you are paying on separate loans and then consolidate and then enroll in PSLF, only those payments made after you've enrolled in PSLF count towards the 120 eligible payments. 10 years may seem like a long time, but at that time, your remaining loan balance could still be significant, especially if you opt for income-driven repayment plan. So if you're entering into a career of public service or teaching, look into getting part of your loan forgiven. Be sure to make payments on time and follow all of the guidelines. Also, contact your loan holder to make sure that your repayment plan is eligible for one of the forgiveness programs so you don't miss out. Non-defaulted loans made in the direct loan or DL program are eligible. These include direct subsidized Stafford loans, direct unsubsidized Stafford loans, direct plus loans, direct consolidation loans, Perkins loans, and some health profession loans and nursing loans are also eligible if consolidated into the DL program. Student loans in the Federal Family Education Loan Program, or FELP, are not eligible for forgiveness unless you consolidate them into the direct loan program. And no payments made before the consolidation will count towards the 120 needed for forgiveness, as I've mentioned before. Defaulted loans can regain public service loan forgiveness eligibility if they are consolidated out of a default or rehabilitated. Also, one great thing about the loan forgiveness program is any amount forgiven through this program is not taxable income. What counts as a qualifying payment? You must make all payments while working full-time at an eligible employer, which we'll go into detail later. Your 120 payments must be on time, full, but they do not have to be consecutive. So if you are in a field of public service, then decide to leave for whatever period of time and then come back and continue and enroll in the program, those payments that you've made after you came back will count towards the 120 qualifying payments so long as it meets the other standards mentioned. You also must be enrolled in one of the income-based repayment plans, either income-based repayment, income contingent repayment, pay-as-you-earn, or revised pay-as-you-earn. Qualifying employment. It doesn't matter what you do, it matters where you work. So these are some of the items or locations where public service loan forgiveness is very commonly used. Any government organization, 501c3 not-for-profit organization. So if you work for a school, if you work for USC, for example, you would qualify for public service loan forgiveness, or other not-for-profit organizations providing specific qualifying services. Aside from finding a qualifying employer, you must be enrolled or you must be working full-time. Now, this doesn't necessarily mean it's one job. You may have multiple part-time jobs that equal full-time, so long as it meets either 30 hours per week or your employer's definition, whichever of the two is greater. Your employer will need to complete the Public Service Loan Forgiveness Employment Certification each year to help you track your eligibility for forgiveness. So aside from also certifying your income and family size for the income-based repayment or income-driven repayment plans, you also have to have your employer complete the Public Service Loan Forgiveness Employment Certification form each year as well. As an aside, you cannot work for a labor union or partisan political organization, and you may work for an organization that provides religious instruction, worship services, or proselytizing if your job functions do not include these activities, but being a member of the union is allowed. Let's give an example of how the income-based repayment plans in conjunction with PSLF can assist with successful management of your investment. In this instance, we have a payment of an income of $40,000, assuming of course that there is a slight increase each year. It goes from year 1 to year 10 with the monthly loan payments off on the side as well. After a total of 120 payments, you pay off $28,817. The total amount forgiven would be $48,465 of untaxed income. So let's recap. In order to be eligible for public service loan forgiveness, you need to have the right loan. So federal direct loans, or if you have a FELP loan, something under a federal direct consolidation loan. You have to have the right job, a full-time employment of 30 hours a week, or the greater of 30 hours a week, or the employer's definition. You can work at a federal, state, local, or tribal government, private not-for-profit 501c3 organizations, or AmeriCorps or Peace Corps positions. And you have to make the right payment, 120 on-time payments under the income-driven repayment plans. Let's go over the action steps if you want to incorporate PSLF into your financial plan after you graduate. The first thing, of course, is you graduate, which you've already done or in the process of. You'll apply for a consolidation loan if you need to consolidate several of your loans, especially those that are under the FELP program. You'll choose an income-driven repayment plan, either IBR, pay, or revised pay-as-you-earn, and start making on-time payments. And then annually, aside from certifying your family size as well as income, you'll be certifying your employment through the employment certification form. Note that all loans that are under the Public Service Loan Forgiveness Program will go under one servicer, myfedloan.org. So they are the ones who are managing and servicing all loans that are under the Public Service Loan Forgiveness Program. It's important that if you cannot make appropriate payments to your student loans, that you let your servicer know. If your servicer does not know, they won't be able to assist you to put you into either a approved deferment status, forbearance, or in some instances, you may need to know what your eligibility is for a cancellation of a loan. If you need a break from your federal student loan payments, you may be able to postpone them temporarily with a deferment. This is a great option for borrowers, especially since the federal government may pay the interest on subsidized loans during an approved deferment. Deferment is your right as a student loan borrower. If you qualify, you can't be denied this option. However, the time you can use this option is limited, which means postponing your payments isn't right for every situation, so choose wisely when pressing pause on your payments. Contact your loan servicer for more information on deferments. If you don't qualify for deferment, you can still potentially turn to forbearance for relief. Before you do, though, make sure you understand some key facts about this option. Your lender or servicer will grant forbearance at their discretion. This option is usually reserved for cases of financial hardship or illness. Unlike a deferment, interest builds up on all of your loans during forbearance. This is capitalized at the end of the forbearance period, meaning forbearance will increase the amount you owe. In general, you're required to fully repay all of the student loans you borrow with interest. However, a few circumstances can get you off the hook for some or all of the amount you owe, though most of them aren't very desirable. Here's a list of the things that may qualify you for student loan discharge. You or the student benefiting from the loan, for Parent Plus loans for example, has passed. In some rare cases, you've declared bankruptcy. You've become totally and permanently disabled. Someone was convicted of stealing your identity and fraudulently taking out a loan in your name that you did not benefit from, or your school owes your lender a refund. Note that the amount discharged may be taxable depending on the situation. There are quite a few tax deductions and credits available just for paying for or repaying your education. You can't claim them all, but letting the government know about your education can boost your refund. One of the items, of course, is the deduction for the first 60 months of repayment. This was prepared for informational purposes only and is not meant to be a tax or legal advice. So if you do have questions about any tax benefits on your student loan repayments, make sure you speak with a tax professional for additional guidance. Students who have received subsidized, unsubsidized, or PLUS loans under the Direct Loan Program or the FELP program must complete exit loan counseling each time they drop below half-time enrollment, graduate, or leave school. So aside from the supplemental webinar, if you haven't already done so, please go to studentloans.gov to complete online exit loan counseling. The entire counseling process must be completed in a single session. Most people complete the counseling session in about 20 to 30 minutes. If you've already done so, note that after this webinar, we'll be pulling periodically exit loan counseling information from the student loan database, so we'll have a record of it. If it hasn't shown yet, it will within the coming days. Note that one of the items that they ask when you're completing exit loan counseling is the name, addresses, and email addresses and phone numbers of at least 2 references. This is essentially so that they can begin having that contact and relationship with you so that they can contact you if there are any changes or any additional information that you might need regarding your student loans. So just be aware of that. They'll be asking for this information. Being past due on a federal student loan payment for 270 days, or roughly 9 months, can land you in the last place you want to be, default. Default can come sooner for some federal loans, like for health professionals, and for private loans too. Default means that you've broken the initial loan agreement, essentially what you signed with a master promissory note, which comes with serious consequences. These can include collection costs, wage garnishments, and seizures on your tax refunds, not to mention the damage a default can do to your credit score. If your loan does default, you can recover. However, your best bet is to avoid this situation altogether. So before you get into default, you might be in what is known as delinquency status, which is any time that you haven't made any loan payments before 9 months, and you will have contact from your servicer. If you are having issues making repayments, again, speak with your servicer who can either get you into an approved deferment period, forbearance, or may be able to assist with choosing a repayment plan that has lower monthly payments. If you have an unresolved federal student loan dispute, the U.S. Department of Education's Federal Student Aid Ombudsman, a neutral, informal, and confidential mediator, may be able to help you. What can the Ombudsman do for you? They can resolve discrepancies about the federal loan balances, understand loan interest and collection charges, identify options for resolving issues related to federal consolidation, service quality, default, bankruptcy, tax offsets, and other concerns, clarify federal loan deferment, forbearance, discharge, and forgiveness requirements, and identify federal loan repayment options. Again, if you are considering which repayment option to use, do not contact the Ombudsman in order to decide that. You can use either the payment estimators or contact one of the servicers or saltmoney.org to assist. Up until 2010, resources for disputing private student loan issues were virtually non-existent. That's when the Consumer Finance Protection Bureau, or the CFPB, came on the scene with a mission to provide American consumers with the necessary information to understand the terms of their financial agreements. Like the Ombudsman for federal student loans, you can contact the CFPB to file a complaint if you have a dispute with your private student loan company that you can't resolve on your own. The SFPB will work with you and your loan holder to find a solution. The SFPB aims to make sure the consumer financial products work for Americans, so it was designed to write rules, supervise companies, and enforce federal consumer financial protection laws, restrict unfair, deceptive, or abusive practices by companies, take consumer complaints, promote financial education, research consumer behavior, monitor financial markets for new risks to consumers, enforce laws that outlaw discrimination or other unfair treatment in consumer finance. If you are having difficulty resolving a dispute with your private student loan lender, you can file a complaint with the SFPB. They will research your problem and attempt to help you find a resolution. Now, managing this investment you've made can seem as a small component to your overall financial goals. And as such, we want to make sure that we also touch upon how you can take control of your finances and be successful. So this portion of the presentation will focus a bit on some of the best practices to manage your finance. One of the most important steps in taking control of your finances is designing a personal spending plan. Whatever your age or financial know-how, when you take a close look at your income and expenses, you can easily determine whether you're living within your means. Once you've tailored a plan to your life or current situation, you'll be able to both spend your money wisely and build up your savings. Whether short-term or long-term, all financial goals should be considered SMART, meaning they are specific, measurable, attainable, realistic, and timely. Specific just doesn't mean you have to say something other than, let's say you just want to save money. Be specific. Specifics help to organize our actions. Let's say you want to pay off a credit card. What's the balance? That is your goal. You want it to be measurable. You can't measure it, you can't manage it. Once you have a specific goal, you need to know how well you are doing to meet that goal. You can see every month you make a payment on your balance will go down, which is why a repayment of your student loans can be seen as measurable. It has to be attainable. When you identify goals that are most important to you, you begin to figure out ways you can make them come true. Goals you set which are too far out of your reach, you probably won't commit to doing. They have to be realistic. This is not a synonym for easy. Realistic in this case means doable. Be sure to set goals that you can attain with some effort. Too difficult and you set the stage for failure, but too low sends the message that you aren't very capable. Set the bar high enough for your satisfying achievement. Timely. Set a time frame for the goal, for next week, in 3 months, 18 months. Putting an end point to your goal gives you a clear target towards your meeting your financial goals, and also a clear target to work towards. So once you're set up your financial goal, the first step to setting up the spending plan is to look at your income and expenses as a fixed expense. Note, once you've come up with your total monthly expenses, you'll need to determine your monthly income. If you received a fixed paycheck, regular installments of financial aid, or regular contributions from your family members, you'll be able to simply use these figures. Secondly, track your monthly expenses that you will always have to pay, your rent or mortgage, your utility bills, your phone bills, and so on. These fixed expenses are generally regular costs that you want to cover before anything else. If you have credit card debt or student loans, you'll want to factor in the amount you're paying off each month. This is a good chance to catch up if you're behind, as you can align how much you're able to pay with how much you want to pay. If you don't have these debts, consider putting in an amount you'd like to save each month. Next, you'd like to figure out how much you spend on flexible expenses, like groceries and transportation. Even though you can't know for sure how much you'll spend on these categories, you should be able to come up with a general figure by looking at your recent spending. That's why tracking your expenses is important. There are plenty of apps out there, either mint.com, feedthepig.org. Also, banking institutions oftentimes provide a categorization option of all of your charges and expenses, so you know where your money is going. Remember, it's a good idea to round these figures up, especially with the flexible expenses. That way, you're less likely to come up short, even if you spend more than usual. Finally, remember that a responsible budget doesn't mean you can't spend money on yourself. Just think about how much you normally spend on discretionary expenses like clothing, movie tickets, and eating out, and allocate some of your income to them. By working these costs into your spending plan, you won't have to worry or feel guilty about buying a new sweater or having a night out. Pictured here are a couple of the items that people tend to habitually spend on that are small expenses that can overall grow and become kind of a nuisance overall time. Some of these things, obviously eating out, in-app purchases, these are all items that we, without thinking, spend money on that add up over time. I mentioned credit cards earlier. As long as you use your credit card responsibly, it can be a powerful tool for making purchases, protecting your finances, and building your credit. The process for applying for credit cards sometimes sounds challenging, but the benefits may be worth it to you. Establishing credit is essential for many things. Having good credit can assist with things like renting an apartment, leasing a car, or buying a home, because of the tie a credit card has to building a good credit score. Finally, some credit card companies offer bonus rewards and extra services to their cardholders beyond the benefit of convenience and purchasing power. These can include things like frequent flyer miles, cashback, or personal concierge service that can assist you any time of the day. Credit card companies often charge fees for cards with these perks, so find out if the benefits will be worth the cost before you apply. Finally, some card companies, if you get a card, be sure you can repay any charges you make on time, and if possible, more than the minimum balance. Having access to a line of credit may give you access to more money than you're used to. Remember that credit card companies make money by charging you interest and fees on your purchase. Avoid paying more than you have to by not spending more than you have. Your credit report helps lenders determine if you're a good investment. Credit reports are helpful because they contain a thorough history of every financial account you've ever had, which can be quite a bit of information, but your credit history is one of the keys to your financial future, so it's important to make sense of it and keep track of it. You can pull your credit report by going to annualcreditreport.com. You may pull from one of these 3 major credit bureaus each every 4 months for free. What I would suggest if you want to do a regular monitoring of your credit report is going to one of these 3 bureaus, pull your credit report, review it, and then 4 months after that, pull from the other credit bureau that you haven't used. And then finally, 4 months after that, pull from the final one that you haven't used. And then after a full year, you'll be able to go back to the original one that you had originally pulled from. When we're looking at credit reports, we have to check that our report is correct. So if the first thing to check on your report is your identifying information to ensure that all the personal information and account details are correct. Don't be alarmed if there are a few different spellings of your name or a few social security numbers. There just means that someone reported incorrect information before they corrected it. Your credit history will take up the most space of your report. It sums up all the accounts you have, like mortgages, credit cards, car loans, etc., for each account. You can see whether or not the account is still open, what the current balance is, and if you've been late with any of your payments. There are a lot of details to check, but it's especially important to take notice of anything that's negative, which is the next section of the credit report. This section lists information about things like court records, bankruptcies, overdue child support, etc. It only shows financial information. There won't be any arrests or convictions, but anything appearing here will severely lower your credit score. Credit scores, or your FICO, are 3-digit numbers that determine someone's credit worthiness. Basically, whether or not someone can be trusted to repay their debts. The most common credit score is the FICO score, which ranges from 300 to 850. Your score will be determined by 5 factors: your payment history, which is 35% of your score, how much you owe, 30%, and the length of your credit history, 15%, with smaller items such as the type of credit you have and the amount of new credit you have being 10% each. Note the 2 large factors, payment history and utilization rate. Making on-time payments will help benefit you in the long run as it's tied to the significant item that makes up your credit score. Another factor that affects your credit score is the amount of available credit on your credit card, i.e. how much you have charged versus how much you can charge. This is your utilization rate. Charging little on your card gives you a large amount of available credit, which will help your score. On the other hand, always carrying a high balance on your card may have a negative impact on your credit score. Businesses and organizations like banks look at someone's credit score to determine whether to lend them money and at what interest rate. Keeping track of your number and keeping it up is important because the credit score affects many different aspects of your life, like securing loans for home, cars, or small businesses. In this instance, we're looking at a line of credit for a car for an auto loan for a 36-month fixed rate. Note that the amount of your credit score impacts how much you're being charged or your annual percentage rate and how much of your monthly payment is impacted and total interest cost. One of the good things about your credit report is that it helps you monitor your identity. You want to make sure that all of your information is safe and guarded by yourself. You want to make sure that you protect all of your personally identifiable information, especially those that are linked to your financial records. You want to make sure you read all of your mail, even if you're still getting those the transcripts or the credit card applications. You want to make sure that you rip those up because you don't want to have people opening up lines of credit or accounts under your name without your knowledge. If there's something that you do not need, you want to make sure that you shred it. This includes charge receipts, credit applications, insurance forms, expired credit cards or debit cards, and checks and bank statements. And then if you are going to be away from your home or your residence for a long period of time and you do have mail, especially those that will have personally identifiable information, you want to make sure that you put a hold or you have that mail forwarded somewhere else. Data breaches are a thing that are becoming much more common, unfortunately, and we're noticing that a lot of our personally identifiable information is starting to become more and more accessible. So monitoring our credit report and our credit history is vital in order to protect ourselves from these breaches. Most of our lives are not only walking about, but also online on the interwebs. So you want to make sure that you have as much protection as possible. Even something as little as having a protection on your phone would prevent anything such as your bank apps, or if you have any of your money management apps on your phone, protected in case you happen to lose it or misplace it. You want to make sure that this is all protected with good passwords, your PINs are private, and you lock your phone with some type of password. And never share any personally identifiable information on social media. One of the funny things about studentloans.gov is that it offers you a Twitter button or a Facebook button. I will recommend that you never use those items to share any of your student loan information on the World Wide Web. A large majority of our presentation was garnered from a lot of these sources: NSLDS, studentloans.gov, but I would like to mention saltmoney.org as a very, very good source of a resource for managing either setting up a spending plan, deciding which repayment plan is best for you, even as something as purchasing your first car. There's a lot of important information there. And as USC students and graduates and now alumni, you are eligible to receive any of that information and log on free of charge. So there's no additional steps you need to do. That concludes our presentation. Note that we will be sending a confirmation that you were in attendance, as well as a copy of this presentation, as well as a survey. Please make sure that you complete the survey, and if there's any other information that you might need, we'll be happy to help you out. Thank you very much, and fight on.